If you're an investor, whether you're an investor in shares or an investor in perhaps an asset that's going to throw off some revenue, some cash flow into the future, you're going to have to understand and get your head around a concept called discounted cash flow or net present value. It's a method of valuing a future flow of cash or return on an investment. Warren Buffett, one of the most successful investors of all time, the guiding spirit along with Charlie Munger of Berkshire Hathaway, says that the only way to value a share is with the discounted cash flow or net present value method. The starting point for understanding the valuation method is that 5,000 in a year's time or 3 years' time or 5 years' time isn't worth as much to you as 5,000 now. In other words, money in the future isn't worth the same amount as money today. In other words, it will have a different net present value. And what you need to do if you're looking at investing in a machine or investing in shares, you need to estimate as best you can the return, the cash returns, let's just say for the sake of argument, in shares, the cash return on the shares over the next 5 or 10 years. And then you discount those shares, or the cash flow rather, to take into account two things. One, inflation. In other words, the 5 grand in 3 years' time is not as valuable or is not worth as much as 5 grand now in your hand. And two, risk. In other words, you might get 5 grand in 3 years' time, or you might get a certain cash flow in 3 years' time or 5 years' time. But there's always a risk. There's always a risk with any investment. So essentially what you do is, you are looking at a share, you will be able to look at previous dividends that were paid on the particular share, and then you're trying to extrapolate into the future what the dividends are going to be, what that return is going to be on your investment in the share or shares over the next 5 or 10 years. You're going to apply then a discount to take into account inflation and risk, and that's going to give you a net present value for the share price. So if the share price is currently trading at say 15 euros, and you estimate then your cash flows based on historical dividend payouts and historical cash flows, and you estimate it then into the future for 5 or 10 years, you're going to arrive at a net present value for that share. And for the sake of argument, let's say it's trading today at 15 euros and the net present value is 13 euros, then it's clearly overpriced and not a good investment. However, if based on the future cash flows by way of dividends, you're going to get back over the next 5 or 10 years exceeds the 15 euros current share price, in other words, the net present value exceeds 15 euros, then it's a good investment, it's a good buy. And the discount factor that you're going to use will vary depending on inflation, will depend on the return that you might get on government bonds, and will depend on the risk attributable to the particular share. So if you're buying a share, for example, in a blue stock, or a blue chip company rather, then there is going to be a lower risk of dividend failure over the next number of years, as opposed to a more risky startup stock. So that's essentially the basis of the discounted cash flow or net present value of valuation. And it is one, as I say, that Warren Buffett of Berkshire Hathaway swears by, and he says that is the way to value shares. Now, online you're actually able to get a discounted cash flow or net present value calculator. You can actually get them online, or there's actually a mathematical formula essentially, because all you're doing is applying a discount factor to a future stream of cash flow, and that can be based, obviously you need to predict the future stream of cash flow and apply whatever discount factor. But if you go to the Microsoft Excel spreadsheet, you'll find one of the formulas there is net present value or discounted cash flow. And likewise with the Google Sheets spreadsheet program. It was originally invented, the method of valuation, to look at capital investments by companies in, for example, a machine. Let's say a machine is going to do a certain amount of work and produce a certain amount of revenue over 5 or 10 years, and obviously it's going to depreciate in value and eventually end up being scrapped. But you can, or a company could, estimate fairly well the potential return over the next, say, 10 years with the machine, and then they're going to make an assessment, as it were, a valuation of what they should be paying for that machine now. What is the true cost of it? What is the net present value based on discounted cash flow into the future? Anyway, I hope you find this video useful. If you have an interest in investing in shares or property, I have a course that I made. It's an online video course. You can check it out. I'll put a link in the description down below. It's on Teachable. Or you can have a look at my website, businessandlegal.ie. There's a page there which just explains about the course. There's 35 videos, I think, in it. And half of them deal with property and half deal with investing in shares. And in the course I share what I've learned over the last 35 years, I think, of investing in property and shares. Anyway, hope you find the video useful. If you do, I'd appreciate if you gave it the thumbs up down below. Thanks a lot.